today's topic is understanding the monetary policy. Guys, if I tell you that monetary policy is the backbone for any investment banking student, why? Because one monetary policy can change all the investments instruments in any economy. That is why monetary policy is considered one of the most crucial thing to follow up for all the investment banking students. You might have heard multiple times that when the Fed changes the interest rates in America, the implication of these interest rates, it transfers and it is replicated throughout the world. So that is why understanding monetary policy is one of the most crucial chapters in when we talk about investment banking. So agenda of the day would be that we are going to study what is money market, what is debt market, and why we are studying money market, because money market is linked with monetary policy. Then we are going to discuss what is monetary policy and what is the difference between fiscal policy, what is money supply, and how and why money supply should be controlled, why money supply plays a very crucial and important role when it comes to monetary policy, and how monetary policy tends to regulate money supply, and what are the implications of money supply in the entire economy basically, and what are the government securities. We are going to discuss government securities in this chapter because government securities are considered as a tool of monetary policy. So we are going to discuss all these things in quite detail. Now, guys, if I start my session, so today's session we are going to start with monetary policy. As the term itself suggests, it is something related to money, literal meaning, money, monetary. It is sounding quite it sounds quite same to money, monetary. It's very similar, right? And literal meaning is also it is something related to money. And how come money? It is related to money supply basically, right? So monetary policy is a policy which is given by the central bank of a country, of any country. In all the entire world, in all the countries, there are central banks. For example, in India, it is Reserve Bank of India, RBI, right? So monetary policy is a policy which is drafted by the central bank of any country. That how come it is differ? It is different from fiscal policy. It is different from fiscal policy because fiscal policy is given by government of India. Now this term is so complicated sometimes. Fiscal policy, what does it means? So in very simple terms, if I tell you, fiscal policy is the budget of a country. Means, you might have heard budget is coming, our finance minister, she gave budget just few months back. So what I want to say, budget is called as the fiscal policy of a country. So monetary policy is given by RBI and fiscal policy is given by government of India, that is finance ministry. And monetary policy is given every quarter, 4 times in a year. You might have heard, the interest rates keep changing, and you must have heard this news as well multiple times that again interest rate changed. So we are going to discuss what kind of interest rates these are. But what I want to say that the monetary policy is given 4 times in a year. But on contrary, fiscal policy is given once in a year by the finance minister. So what is fiscal policy, or what is budget? Budget is basically from where the money is coming and where the money is being spent by the government of the country or by government of India. Let me repeat myself again, that where government should be earning its money, where the revenues would be coming to the government, and once the money had come, in the pockets of the government, how that money should be well spent. So revenue and the expenditure of the government of India is decided by fiscal policy, and all the terms and conditions, taxation, all these things, income tax, GST, all these things comes under fiscal policy. And how that money, direct tax, indirect tax, money coming from these taxes, how that money should be used, consumed. So that comes under expenditure of government of India, right? So it should be used in building hospitals, infrastructure like roads, multiple ways, right? So this is how a fiscal policy is used from, so that government should get to know that where its money should be coming, revenue should be coming in, and where that money should be used. This is policy, fiscal policy. This is budget. Now coming to monetary policy. So as I told you, monetary policy is given by Reserve Bank of India. Monetary policy is given 4 times in a year. But the main target of monetary policy, as the word itself suggests, is to control the money supply within one economy. Let me repeat myself again. We are going to understand this thing, what money supply is. But the main target of monetary policy, as the term itself suggests you, that it will tend to control or regulate the money supply. Whereas the main objective of fiscal policy was the revenues and expenditures of government of India. So this is the main difference between fiscal policy and monetary policy. So why government wants to regulate money supply? What is the purpose behind regulating this money supply? So the purpose behind this regulation of the money supply is to control inflation and the growth. Just imagine, guys, it is a very powerful tool. Reserve Bank of India sitting in Mumbai, Government of India Finance Ministry sitting in Delhi, how they can control inflation of the entire country. Have you ever thought of this thing? Means sitting at one place, how can they can control entire nation? There must be some tools, right? So we are going to discuss these tools. And using this monetary policy only, government controls inflation plus it regulates the growth of the nation as well. So inflation and the growth can be altered, can be regulated by monetary policy. So it's a very very powerful tool. So that is why we are going to discuss what monetary policy is quite practically, quite conceptually, and in a very easy way. All right, so let's proceed further. Now let me give you one example over here, one very interesting example, guys. When you were in your first standard, second standard, in your school days, basically, when you were, when you used to had summer holidays, just imagine that time. No tensions, no homework, nothing, just summer holidays. And your father, your grandfather, they used to give you 10 rupee, 5 rupee, 10 rupee. Go beta, enjoy yourself. And all the siblings, your siblings, your neighbor, the children who are living in the neighborhood, and they all are having holidays. So everyone gets 10 rupee from their from their parents or papa and grandfather, like that. Now, this is something, once all the siblings, all the brothers or brothers and sisters, or all the friends, they're having 10 rupee each. So what's the first thing that you would do in those childhood days? So I know what you would do. You would go to the nearest shop and you will buy chocolates, cold drinks, maybe nowadays pizza, something like that. But you are going to spend that money and you're going to spoil your teeth and spoil your health. This is how the things work out. Now just imagine that moment, guys, when all of you are having money, all of you are having 10, 10, 20, 20 rupee. This is the time when all of you are having money, is called as money supply is high, because you are having good supply of money in your hands. Once the people have good amount of money, what they do, they spend. Very rare people, they tend to save the money. Out of all the siblings, one or two siblings will keep that 110 rupee for future use, but generally all the siblings would spend that money and enjoy that moment. Basically, this is how the things work out. Now just imagine you're doing this every day. Every day you're getting 10 rupee as a child, in your summer holidays, and every day you're spending your money, drinking cold drinks and eating chocolates. One day your grandfather get to know that you are eating chocolates every day and it's going to spoil your teeth, right? So what your grandfather would do? Your grandfather will scold your father first, that you should not, spoil the younger ones, or you should not give the money to the younger ones. So this is how he will guide your father, basically. Now, what your father would do? Your father have two or three options. First, he will be very strict with you, and he will take your money by just scolding you. Ki, beta, you can't spend such kind, you can't spend the money in a wrong way, so you just have to give all the money back to me. This is the first way. Second way, your father could be a very, moral, very philosophical type of person. He may guide you, beta, spending money is not good. So you should not do such kind of things, and you just give him money to me. Third way, your father must be, if your father is a very practical person, what he will do, he will say to you, Ki beta, give me your 10 rupee today. I will return you 15 rupee in exchange after 6 months. It's a deal. Means he's taking your money with a promise that he will give some extra interest on that. So, guys, we are discussing two scenarios over here. Scenario number one was when your father used to give you 10 rupee every day. This is the time when the money supply is very high amongst all the siblings. You all are having good amount of money, your pockets are full with 10 rupee, and you are enjoying your money or buying stuff. So this is situation number one. When government is giving the money to the citizens, to the people of the country. When your father, your grandfather is giving the money to you, take beta, take the money and enjoy yourself. And obviously, if you have the money, you will spend the money. This is situation number one, when all of you are having good amount of money in your hands and you're spending that money. Now there would be situation number two over here as well. When your father, your grandfather get to know this thing that you are spending money mindlessly, you may ruin your health. So they will tend to suck the money back. So they will try to take the money back from all of you, means all the siblings, right? So what they will do, they will either guide you, very, very politely, beta, there is no need to spend such kind of money, mindlessly, and you just give the money to me. This is called as moral push. He's trying to guide you morally. But even if you don't listen to him, even after all kind of guidance, what he will do, he will tend to become a bit strict with you. He will say, beta, there is no need to spend money mindlessly, give it to me. So he may become strict as well. So you don't have any option, right? You have to give the money to him because you have to stay in the home, right? So you will give the money to him. So what's happening? He's taking money from the economy, he's taking money from all of you, and he's sucking it back. So this is how the things work out. There is third way as well. In the third way, it's a very practical way basically. When your father or grandfather will ask you, give your 10 rupee to them today, they will return that after 3 months or 6 months with some extra interest on that money. Means you have 10 rupee, you give it to your father today, he will return 15 rupee, means 5 rupee extra after 6 months. So you're making a profit of 5 rupees. So it's a good deal basically. All you have to do is give your money to your father. But in all these scenarios, he and your father, your family members, they are sucking back the money from all of you. So once you will not have the money, you will not spend it. You will not buy chocolates. So just by using few tools, they just suck the money back. So this is how monetary policy works. Now let's see how it works in the real life scenario. How it works. Let's see. So what exactly happens? Grandfather was an analogy for RBI. Grandfather is of a family is just equivalent to RBI. So it's RBI who decides what to do, when to do. Papa and father was equivalent. It was an analogy for your banks, the banking system of the country. And your siblings are just like citizens of India. So it was an analogy which I gave a story to make you to make you understand how this monetary policy works basically. Now what exactly happens? Let's see the case when you were having good amount of money in your pockets, when you were having 10 rupee each in your summer holidays. Your father used to give 10 rupee every day, and all of you are having good amount of rupees. See, there are so many coins, gold rupee coins over here at the bottom. So it means all of you are having good amount of money right now. So it means market is very liquid. Market is having good amount of money supply, because when all the citizens or all the siblings are having money in their pockets, it means you are full with money, and this is called as high money supply time, right? High liquidity time. So once you are having money, definitely you are going to buy stuff. Definitely you are going to use money, right? But once your grandfather, he gets to know that you're spending money, and you may end up spoiling your teeth, your health. So Your grandfather will ask your father, means RBI will ask the banks of the country that people are having good amount of money. It's the time to suck the money back. So what your grandfather will do, your grandfather will ask your father to use the tools which I just told you. Tools could be either he could be strict, either he could be philosophical by guiding you, or either he could give you some greed of, we can say interest rates. So he will give you some interest rate that beta, you just give your money today, I'll return it back 15 rupee, 5 rupee interest after 6 months. So I just try to impress you with that interest rate. So these are the tools. So this is how RBI also do the same things. RBI will keep an eye on the entire country, that what is the situation of the money supply, and this happens every quarter, by the way, huh? So that is why monetary policy comes every quarter, 4 times in an year basically. So what happens over here? RBI keeps a check on all the citizens of the country, means what kind of money they are having, what you people are doing with the money. If the money supply is less, RBI will try to increase it. If the money supply is more, RBI will try to suck the money from the entire country. The same way it happens in an Indian household, in a family, within a family, when you are having a holiday with the siblings, same happens in a larger scale, macroeconomic scale. RBI and banking system, they use monetary policy and they tend to regulate the money supply. So what will happen, if we regulate, or if we constrict or expand the money supply, that we are going to discuss in the coming slides. But I hope you understood this story, how RBI and how your grandfather infuses money amongst all the siblings or amongst the citizens of the country, and how they tend to suck back the money from the entire economy. So this is how the money supply, the monetary policy works. So monetary policy, as the word is itself was suggesting you, monetary means something related to money supply and how it tends to regulate it. So as I told you, if money supply is high, you will tend to do more expenditure, and more expenditure may tend to have some effects in the economy that we are going to discuss. And in order to decrease this money supply, what would happen? This is step number two. They will either do strict parenting. Strict parenting means RBI will become strict and RBI will ask banks to suck back the money. How? That we are going to discuss. Or it could be emotional blackmail or philosophical advice. That could also be done. Moral push is also philosophical advice. And next is interest rates. So using those interest rates as well, you may end up giving your money to your father in the bank basically. How it works in the real life? Step number three, it is done by quantitatively or qualitatively. Let me give you one more example of qualitatively, right? So qualitative measures are done in this way. For example, you are having 100 rupee in your pocket. And being your father, instead of taking that money from you, what if I redirect that money somewhere else? How? Let me give you an example, practical life example. I ask you, beta, why don't you join a karate class? Why don't you join a guitar class? And you pay that 100 rupee as a fee over there. So what I did this time, I didn't take the money, I didn't suck the money from you. I just redirected it somewhere else. So anyhow, that money will not remain in your pocket. That was my agenda. That was my motive. So either I take it or either I redirect it somewhere else. It's just the same thing. So this is called as priority sector lending. When I decide a sector and I redirect the money of all the citizens, all the siblings at that direction. So being a father, if I say to all the siblings that you are having 100 rupee each, why don't you learn karate? Why don't you learn guitar? Why don't you go for some swimming classes? So what I am doing here, I am redirecting the entire money of all the siblings or all the citizens of the country at a specific sector. So what would happen? All of you will start going to swimming classes, and by doing this, I took the money from you and I redirected in a specified sector, and you will not have the money, right? So this is how it could be either redirected, either sucked, or this is how the qualitative and the quantitative tools work. Quantitative means interest rates, qualitative means either morally, emotionally, philosophically, means or redirecting. Quantitative interest rates, qualitative, philosophically, emotionally, or by doing some kind of priority sector lending. So this is how the entire concept of monetary policy, money supply works. Very important concept and very important and very crucial for all the investment banking students. Now, what are the tools of monetary policy? Now, guys, things will become very easy because if you have, felt that story which I just gave you, things will become a cakewalk for you. Entire monetary policy will become just a cakewalk for you. Now, as I told you, let's start from qualitative tools. Qualitative tools which can't be measured, right? So these are the tools for the monetary policy, how it works basically. Now we are going to start with qualitative tools first. Now, as I told you, qualitative tool number one could be moral guidance. So I would be guiding the children, I would be guiding the citizens of India that, guys, you are having a lot of money, you may end up spoiling your health. Let's give your money to me. So it's nothing, I'm just guiding you, I'm just advising you. So this is how it works in morally. So morally is something philosophically when I am tend to guide you. And out of not all the siblings, not all the citizens, but some citizens and some siblings may understand this thing, and they may not. They may stop or they may not spend money, so blindly or mind not. They may end up, spending money mindfully at least. So this is an effect. So morally and philosophically, it comes when there is no grave situation arising yet. So we are just guiding them, so they may listen. Second is priority sector lending. As I told you, priority sector lending is something when I am redirecting that money to a specified sector. When you were siblings in your summer holidays, as I told you, being a father, I may guide you to use the pocket money either in swimming, guitar classes, or karate classes. So I am directing your money at a specified sector. So your money is going at a specified sector. So this is called as priority sector lending. So government do decide such kind of things like, agriculture is a priority sector lending. So sometimes small startups, MSMEs, government wants to push these things ahead. So whenever government decides something that, this should be a priority sector lending, the money supply goes in that direction. Means if I decide swimming would be a priority sector lending, all of you would start taking the swimming classes, and the entire money supply will be directed towards the swimming instructor, to the swimming classes. So what is happening, I am redirecting that money. So the whole and sole motive is to take the money out of your pocket and redirect it somewhere else. I don't want that money to be free so that you spend that money blindly. So what I want, I am just redirecting it. So this is called as qualitative tool number two. Number three, loan margin requirements. Guys, loan margin requirements generally means if I want 100 rupee loan, that sometimes I have to keep 30, 40 rupee as a collateral, right? So these margin requirements can increase, can decrease. So I can increase it, means for example, let's give you two examples. I want 100 rupee loan. To take that loan, I have to give collateral of 40 rupee, for example, right? Now, if government increase the collateral, means if I want 100 rupee loan, government increase the collateral to 60 rupee. So you know, it will discourage people to take more and more loans. On contrary, if I want 100 rupee loan and government decreases the collateral to 20 rupee, now more and more people will take loans. So this is how, this loan margin requirements can also affect the, money supply, because if more and more people will take loan and loan becomes so easy, so people will take loan, money supply will increase, and money supply can bring multiple, cascading effects that we are going to discuss, how money supply can bring positive and negative changes. We are going to discuss that. At the last, the fourth qualitative tool is strict action, or becoming strict. So RBI can issue strict guidelines. RBI can issue, strict notices against the banks. So banks may have to stop giving loans, stop giving, reckless loans to people, because what happens, bank, the main motive of bank is to give more and more loans, right? So RBI may tend to issue some notifications against that. So this is how RBI can control, the money supply in an economy qualitatively. I hope you're getting the point. Now coming to quantitative tools. Now, as I told you, these are the interest rates. In very simple terms, these are the interest rates: repo rate, reverse repo, CRR, SLR. So what exactly happens over here? This we are going to discuss in the coming slides. The best example is that if I ask you today, you are having summer holidays again, same story. I ask ki beta, give your 100 rupee to me today, and after 6 months I will give you 120 rupee back. So you will making profit of 20 rupee, right? So by doing this, you will become motivated to give your money to me. So I am sucking the money. Similarly, RBI can increase and decrease these interest rates so that banks give the money to RBI, and banks don't have the money to give loans. And if they don't have the money, so people will not take loans, and it's quite critical things. There are multiple things in this we are going to discuss in the coming class. But till now, just keep this story in your mind. Interest rates can suck the money from the economy or can infuse the money in the economy. So why this is happening, how this is happening, we are going to discuss in the next slides. So these are the tools of monetary policy. Quantitative, under quantitative, all the interest rate comes. Under qualitative, things apart from the interest rate comes. Right, now coming to the next slide. Now this is something which is quite crucial. How this money supply works, how what happens when monetary policy increases or decreases money supply in an economy, and what is the effect on the growth, then growth of a nation. So how could a small policy can change money supply, can change growth as well, and what is the main objective of monetary policy, that we are going to discuss right now. Starting from the step number one, if people, I want you to relate it with the story as well, with the summer holidays story. It's just the same. So we are going to understand how a small monetary policy is affecting growth of a nation. All right. Now, if citizens of a country are having more money, let me repeat myself again. If the siblings, when you are having summer holidays, all of you are having 10 rupee each, right? What would you do? You will have more demand. Demand of what? Demand of products. Because now you are having 10 rupee and you are getting that 10 rupee every day. And being a child, if you are getting 10 rupee pocket money every day, you are the king of the world. Means what I want to say, you can buy the stuff that you have wanted: chocolates, chips, cold drinks, like that. There will be more demand. And if there is only one shop in your locality, what will you do? You will go there every summer afternoon and you'll buy stuff. Not only you, your neighborhood friends, your siblings, everyone is going to that shop, and they are demanding more and more chips, more and more chocolates. Now, what would happen? That shopkeeper has to call the wholesaler and the factory owner that now children are demanding so many chocolates. We need more supply of the chocolates. Now, in order to fulfill this supply, more factories has to be established. Because, for example, if a factory earlier used to produce only 100 chocolates or 200 chocolates, and demand goes to 500 chocolates, so more factories has to be established, or more production has to be increased to fulfill the demand. So if more factories are established, it means more machineries are purchased, more lands are purchased, right? And more people will get employment. So if a new factory is established, so it means that factory will employ more number of people. Now, if more number of people are employed, what would they do? They'll earn salaries, right? So if people are earning salaries, what would happen? They from that those salaries they will start saving in the bank. They will start buying stuff in the bank. Now, what is happening over here? We started from money in the pocket. Now, let me repeat myself again. You were having 10 rupee each. All the siblings, all the friends, they got together. They started going to a shop every day. They started buying chocolates. The chocolates, the inventory of the chocolates started declining. So the shopkeeper called the wholesaler called the factory owner that we need more chocolates. So factory owner started a new factory of the chocolates. Now for the new factory, new people were employed. Now new people employed, this they earn money. Now they earn money, they also started buying stuff. So one small thing at a small locality of a country, means small locality of your neighborhood, it created a effect in a macroeconomic level. Just imagine children like you throughout the country, if they start buying stuff. So this is going to create a cascading effect in the entire economy. So one increase in the money supply can increase demand, can increase more factories, can increase employment, can increase earnings, and more earning means more growth. Growth in what sense? If I will earn money, what I'll do? I will I'll send my children to a good school. I'll I'll eat good food. I will I'll enjoy a lot, means I'll go out with friends. I'll go out, have a party a lot, like that. So if I am enjoying out, I'm partying. So restaurants are also, earning money. If I am having good medical facilities, hospitals are also earning money. If I am having good health, I'm going to gym. Gym people are also earning money. So it is having cascading effect. Everyone is earning money. So it is increasing per capita income as well. It is increasing growth of the nation as well. My quality of life is also improving. So HDI is also improving. So just imagine, we started from 10 rupee money supply, and that money supply, just made so many, rippling effects throughout the economy. This is how a small money supply can increase growth of a nation. But there is a take. Growth will come at a cost. What is the cost? Now, let me reiterate this thing. It's a double-edged sword, basically, a knife which can cut both ways. How? If growth is more, for example, if I am buying more and more chocolates, the prices of the chocolates will also start going up. Demand and supply. I hope you remember. So if I'll buy more and more chocolates, it will increase the price of the chocolates. So it is causing inflation as well. Let me repeat myself again. More money supply will bring more factories, more employment, more growth. These all are positive things. But more money supply will bring a negative thing along with it. That is inflation. So if the money supply will increase, it will increase the inflation within a country as well. That is not a good thing. So positive things are also happening with the money supply, but a negative thing is also coming on the way. So it is a very thin line that governments have to manage, that growth versus inflation versus money supply. So we are going to discuss this thing. It's a relation basically, guys, and it's a dilemma for all the policymakers of the world, which thing to choose: growth, money supply, or inflation. So this is how the entire system works. Now, what would happen if I suck the money from the economy? If government suck the money from economy, if your father sucks the money from you, or your grandfather sucks the money from you, first, you will stop buying chocolates. Means now you will stop going to a shop in your locality. You will stop buying the chocolates. Now, chocolate inventory will not get it will not get exhausted. Now, what will happen? Now, the factories which we had earlier, the factories will decrease the production. So, if the production goes down, less number of people are required in the job. Earlier, 500 people were required. Now, 100 people would do the same thing, right? Because production is low. So, employment would also go low. If employment will go low, people will not spend the money because now they are not earning. The salaries are going low. So, people will stop spending. So spending will go down. So I will not go to party, I will not go to cinema. I may end up eating healthy food. I may end up eating in a good restaurant or hotel, or I may end up putting my children not in a good school but maybe in a normal school. So growth will also come low. But what will be the positive effect over here? I will bring the inflation low. Why? Because the demand is low. If I am not buying chocolates, anyhow the chocolate prices will also come low. They will come down. So this is how, by controlling the money supply, by sucking the money from the economy, basically, I can affect these parameters. So there are more parameters than this as well. But these are the main parameters which I wanted you to understand. Means what I want to say, that these are the parameters which can be really affected, really altered by by regulating the money supply. So monetary policy regulates the money supply to control growth, to control inflation as well. So these are the two objectives, and the tool we use various tools to regulate the money supply. To the end product is growth and inflation. Right? I hope this is clear to everybody. Now, impact of monetary policy in an economy. So, what is the impact of monetary policy? How the things work basically in a monetary policy. So, if there is an economy like India is an economy, right? Citizens are living, for example, in a family, all your siblings were living, and in a neighborhood, all your friends were living. Now, what happened basically when you were having good amount of money, right? So you were having good economic growth. You were having good employment. Same was happening over here. You were having good money, good demand, more factories, more employment, and more growth. Similarly, if growth increases, I told you these all are directly proportional to each other. Growth is directly proportional to inflation. So if you have more money, you will demand more. So if the demand of the product will increase, it will increase the prices as well. So it will increase inflation. So money supply will increase the inflation, and money supply will increase the economic growth as well. More money supply, more inflation, more economic growth, and more employment. So these things are quite directly proportional to each other. And monetary policy will impact all these three easily. Monetary policy can suck the money supply, so it will decrease all these three. If monetary policy infuses money, it gives you money supply, so it will increase all these three. So this is how government is going to relate, government is going to practically change all these things. Now, second was consumer and business confidence. Let's see how it is related. If you have more money means you will buy more stuff. So business behavior changes, consumer behavior changes. More money, you will buy more. More money, there are more factories. So businessmen also, they are very confident that people are having more money, they're going to buy more stuff. So let's produce more chocolates. Let's produce more chips. So children will eat more. So because they are having the summer holidays, they will eat more, right? So this is how things work. So consumer and business confidence increases when money supply increases. But when money supply goes down, the consumer confidence also goes down, because if you don't have the money, you may not buy the stuff. You will not buy chocolates, chips like that. And if you don't have the money supply, if the citizens are not having the money, if in a locality friends, siblings are not having the money, the shopkeeper will not ask for more chocolates from the wholesaler. Wholesaler will stop buying more chocolates from the factories. So factories will also go low. The production will go low. So this is how consumer confidence and the business confidence also goes down. Now, how it is linked with sectoral, what is having the impact on the banking, real estate, and exports. Now let's see how it works. If you are having more money, more demand. Now, to establish this factory, what would happen? The factory owner will take loans from the bank, right? I told you, money supply, when money supply increases, when RBI wants to increase the money supply, RBI, they tell the banks to, they give loans as much as you want. So if the banks are giving loans blindly, right, the people will take more loan, more money supply. What would happen because of these loans? People will buy stuff, more stuff. People will establish more factories. Businessmen will establish more factories, right? So this is how banking system gets affected by the money supply. Who is the main, you know, stakeholder in the monetary policy? The stakeholders are RBI, banking system, and the citizen of the country. Though the stakeholders are also there because it impacts all the economic activities in a country. But the banking system is the main, we can say, stakeholder who under, you know, on which all the parameters, all the tools, they are tested upon, basically. So bank, all the interest rates, they are impacted in the monetary policy. How real estate gets impacted? More money supply you will be having, more people will buy more houses, right? If the money supply is less, people will buy less houses. If you are getting loans easily, you will buy real estate. But if government, makes loans bit difficult, you will not buy the real estate. So definitely all the sectors are getting impacted. These are just the few sectors I'm written over here, but they are all, it's almost all the sectors in an economy, they get impacted. Now, wealth and asset prices and investments. See guys, once the monetary policy is issued every quarter, once the interest rates are announced, banking sector, gold, real estate, stock market, debt market, all the markets are impacted. Your savings are impacted. You might have seen, people anxiously wait what is going to happen in the interest rates. Now, this also impacts the startup culture because if the interest rates are easy, so people will take loans easily, right? So they will establish more businesses. If the interest rates are high, people will stop establishing new businesses. New businesses are very important for any economy because it's good for employment, it's good for growth of a nation, right? So just imagine one monetary policy impacting all the sectors across. So this is why monetary policy plays a very important role. Now, guys, money market why money market is important when it comes to monetary policy, right? Now, this is a very critical concept. Now let me let me take you back to that story, the old story. And for this story I again need a piece of paper, basically. Now, summer holidays, I hope you remember that story. You were having summer holidays, right? And in summer holidays you were having, all of your friends and all the siblings are having 10 rupee each. Now, being a father, I want to take that money from you. Now, what I could do? If I give you an offer that you give your 10 rupee to me today, but I will return 15 rupee after 1 year. So it's a good deal, right? But why would you trust me? One thing is I'm a father, right? But there should be some agreement, right? So if I write all these terms in an agreement, in a piece of paper, a promissory note that I, Mr. Pranavyas, will take 10 rupee from you and I will return 15 rupee after 6 months. And I give this piece of paper to you in exchange of your 10 rupee. So what is being exchanged? I am taking your money and I am giving a security, a piece of paper to you, a bond to you. So this piece of paper can be called as bond, can be called as a promissory note, can be called as a government security. Now, I want you to understand this thing. There is exchange taking place. Exchange of this government security, this bond against your money. So if I want to suck money from you, I am giving this government security, this bond to you, and I am taking the money. And if I want, or if you want your money back, you are giving this piece of paper back to me, and I am giving your money back to you. So there is exchange taking place. So it means it's a market. In a market, exchange takes place. A transaction takes place, and transaction takes place always amongst two people, right? Against two stakeholders, one who is giving, another who is receiving. So there is a transaction taking place, exchange of a product against money. So what is being exchanged? Your money with is exchanged with a security. This can be also called, because it's a non-tangible thing. It's not a gold tangible stuff. It's a non-tangible security. So your money is being exchanged with a security, with a piece of paper, basically, right? So this piece of paper, this bond, this government security is being used to make a transaction against your money. So it's a transaction. So that is why we need to study what is debt market, what is money market, right? And what is the role of these two in monetary policy. Now, let's understand what is debt market. So I hope you understood, there is an exchange and transaction taking place. That is why we are studying debt market and money market. Now we need to understand what exactly these are. Now, debt market is a market where debt means loan, kind of loan, right? But over here, I'm not taking loan from bank. Mind it, huh? I can take loan from the banks, but banks charge 10 to 14% interest on the loans. Easily 40, up to 14%, very easily, right? But what if I go to public and take money from the public? Means, just standing like a politician. Ki, hello everybody, I am Pranay Vyas and I need money. Please give me some money. So why would you trust me, right? But what is happening over here? I am using again the same piece of paper, writing, I Pranay Vyas want 1,000 rupee from each one of you. In return, I will give 1,000 and 1,200 rupee, 200 rupee interest after 6 months or after 1 year. I will give this piece of paper to you and I will take money from you. This piece of paper again is a bond, is a government security, is a security, or it could be called as a promissory note because I'm promising something. Though it could be said promises are meant to be broken. That's a different case. But yes, I am taking money from you and I am giving this thing to you. Now, in debt market, the benefit is that you can raise money from people at the rate of 5%, at the rate of 6%. Quite better, much better as compared to a bank. 14%, just compare 5% with the 14%. Being a businessman, it's better for me, 5%, right? For 1 year, I'll be raising money, and after 1 year, I'll return your money back. So it's a good way. So this is called as debt market. Debt market where I am taking loan, I am raising money from public against the issuance of a security, a bond. This piece of paper is called as a bond, right? So why I have written this word happy birthday and greater than 1 year? Why? Because in debt market, guys, you can raise money from the public for more than 1 year, means 2 years, 3 years, 5 years, 7 years. So this is the benefit of debt market. Whereas money market, this is something we needed today because it is used in monetary policy. Money market, there are no happy birthdays. It is something, just remember, it's a trick to remember basically. In money market, there are no birthdays. In debt market, there are birthdays. It means I am raising money or I am issuing these bonds for less than 1 year, less than 365 days. So that is why it is called as money market. So guys, it is very important. Now what I'm going to say, it's very important. Monetary policy instruments or government securities are very liquid assets. It is just equivalent to cash. Cash is the most liquid asset. You must be knowing this thing. So this is what I want to say. Money market is a subsection of debt market. It is a sub part of debt market. These all both are same. In both the cases, we are raising the money against the bonds. But there is one specification under money market. That specification is I can't raise money for more than 1 year. I can raise money only in days, and that too less than 365 days. It could be one few weeks, it could be few days, it could be few months, but never more than 1 year. So that is why no birthdays in money market. So let me repeat myself again. Let me conclude these 2 points. As I told you that being a father, if I wanted to take money from you, from all your siblings, I would have given a piece of paper. This is a promissory note where I am promising you that yes, I will be returning your money, and this promissory note is a good trust factor for you as well, that there is something written you are having, right? So I'm giving this for you, and you can exchange this thing. So that is why there is exchange taking place, exchange of a non-tangible, security with the money, right? There's an exchange, so that's why it's market. But this exchange is for only 1 day, or it could be for 3 months, it could be few weeks, less than 1 year. So you can redeem your money any point if you want. You just give this piece of paper to me, your father, that dad, I need my money. You just give me the money back. So I will take this piece of paper and give you money back. So you have just submitted your money against this promise, right? This is a promissory note. So why this is important? Because RBI, you know, sucks the money, or RBI infuses the money against the piece of papers only. And these piece of papers are called as government securities. Yes, government also issues bonds, and government also requires money. Why would government require money? See, government needs to build infrastructure like roads, highways. Government needs to build colleges, schools, universities. So from where government can increase the revenues? From taxes, direct taxes. What if government needs more money? So government can raise money using these bonds only. This is what Nitin Gadkari ji is doing. He's our transportation minister. What he is doing, he's not using taxpayers' money, though that is also used. He's raising money from public, issuing bonds, and only because he's getting instant amount of money. That money can be repaid after many years because that is debt market instrument. Debt market means more than 1 years. More, there are happy birthdays, right? So he's going to repay it after many years. But roads are being built because he's raising money in a very fast pace. So I hope you're getting the point. Government needs money, and that is why government issues bonds. Bonds, I'm saying. Now, why would government issue government security then? Government needs to suck the money from the economy, from the banking system. And to suck the money, government needs to give something in exchange. So that is why government securities are issued. Now I hope you got the point. Because being a father, if I want to suck money from you, from your siblings, I need to give something in exchange, a promise. So that promise is a government security. And that promise is given by RBI to the banks, to the people of the country. That you give your money to me. You can take your money, you can redeem your money any point of time in future, but you give your money to me for 1 quarter, for 2 quarters, for 1 year, so that I can suck the money. Being RBI, I can suck the money from you, and in return, I will give you a piece of paper. Anyhow, you can't use this piece of paper to buy a television, to buy an iPhone. For that, you need money. But my objective was to suck money from you. So I hope you got the point how this debt market, money market instruments work, why government raises money from the public, and what are debt market instruments, what are bonds, and what are government securities. Right? T-bill, treasury bills are part of that. We are going to discuss that in the coming classes, guys. So I hope you understood it conceptually, how the things work, what is the role of a government security, right? Now, this is a definition. Government securities, or we also call it GSECs. So we are going to use this term multiple times in the next coming classes because government security will play a very important role in repo rates, reverse repo, CRR, SLR. So this term will come again and again, right? So now you will have a good understanding why government security is used. Government security is a tool of exchange money, or government security is a tool to suck money from the economy. You can say like this as well. Government security is a way to raise money from the public. Government can raise money from the public. So government security does so many roles, right? So let's read it. Government securities are financial instruments. Why the term instrument is used? Because it is non-tangible, right? Issued by the government to raise funds. So I told you, if government wants to raise funds from the public, so government can raise funds from the public by issuing, government securities. They are essentially debt obligations. I told you, under debt market. A debt obligation means, why the term obligation was used? Because anyhow government has to repay it, because it's just a promissory note. It's just a loan for a specified period of time that the government promises to repay. So that's why I called you, it's a promissory note. That is why the word promise is written along with the interest. So nothing comes free, right? You are giving your money to me, so I have to give you something so that you feel motivated to give your money to me, right? So I will pay some interest on the money which you just gave me at a specified date in the future. So there will be a specified date that I will be giving your money back after a few days, few months. So you are giving your money to me for a specified period of time. In return, I am giving you a piece of paper. It's a promise. My name Pranay Vyas. I will be giving you, uh, in exchange of 100 rupee, I will be giving you 120 rupee, 110 rupee after 6 months. My stamp, my signature. Now take it. Now you will be happy because you have something in return. Means, it's you. It will be a trust factor for you that I gave something in return to you, right? And why I am happy? I took the money from you. Now you will not able to buy chocolate, cold drinks for you. So I managed to take money from you in return of this piece of paper. And why you are happy? That you will be getting 6 rupee, 10 rupee, or 20 rupee interest after 6 months. So both the parties are happy. It's a market. Exchange took place, exchange of a piece of paper with money, with cash. So this is how I sucked money from you with a piece of paper. So money supply is low. When I want to give money to you, I will give. I will give your money back and I will take my piece of paper back. So this is how repo rates will work. So this we are going to understand in the coming classes. Repo rates, reverse repo, how they work basically. So it is exchange of government securities that is taking place. So this exchange is going to help, you know, RBI a lot in terms of sucking the money or in terms of infusing the money. And if I infuse the money, guys, it would be great. It would be if I infuse the money, it would be great for the economy because people will be buying more, demanding more factories, more employment, more growth. But just one factor that is negative. Inflation will be also more. It will also increase. If I suck the money, so people will demand less. So less demand, less shops, less factories, employment will go down a bit, less earnings, so inflation will also come down. Let me conclude myself. Monetary policy is a policy to control, to regulate money supply. By regulating money supply, we are controlling inflation of a country and economic growth. Money supply is used to control the growth and the inflation. The tools are interest rates, psychological tools like advice, moral push. It could be strict actions, it could be priority sector lending, redirecting the money, right? What are the tools? What are the instruments used? The instrument is government securities, bonds. So using these bonds, I can suck the money and I can infuse the money. So exchange of money is taking place against these bonds only. So these bonds, government securities will play a very important role. If you ask, monetary policy affects which sector of the economy? Monetary policy is the only policy that affects all the sectors. It disrupts all the sectors. So if the monetary policy is good, all the sectors will be happy. If monetary policy is bad, the sectors will not feel comfortable. All the businesses, it affects all the sectors basically. So in the next class, we are going to go with the interest rates, how it works, right? So similarly, we are going to work on this. So guys, I'm really glad that you listened to me so patiently. Thank you very much for your time. I hope I cleared the concepts of monetary policy in a very lucid manner, very easy manner, because it's a very conceptual topic.